Today's webinar is sponsored by Trade360, one of the A to Z approved brokers, one of the very few A to Z approved brokers out there, which means that it is a broker that has been tested and passed all the tests. That being said, based on yesterday's analysis, we will continue and add on the comments that we have been talking about, and we will be sharing some of the insights that you have missed, or you probably would have missed if you were to trade yesterday. First thing first, let's start with the crude oil, the WTI. If we look at the crude oil overall, you will see that yesterday the crude suddenly started to appreciate. And the reason behind crude appreciation, yes, it was due to Iran more than the crude oil inventories. Yes, the crude oil inventories went down. However, the thin line there was not the production cap or something like that, but Iran said Iran oil minister said one quote: "We will be there to do whatever it requires with the rest of oil producing countries that will stabilize the oil market, including a price cap." So the second that we saw the including price cap hit the market, basically, that was the main time that we had crude oil surging. And the crude oil surging that I'm referring to was just about at $29.50 level yesterday. And now we are approximately almost $2 from where we were left. Now you may be asking where or what we could be expecting out of this quote. Where could we go? First thing that you need to understand is the fact that it hurts pretty much every single oil producing country to have the oil prices below $30. So you will of course see each time crude is going below 30 level, we see some strange news coming out and it pushes it up. Like here as well, hitting the 30 level, it pushes it up. So $30 per barrel, I'm talking about the WTI, is a very pivotal level for the crude prices. Nonetheless, we need to look for this level more clearly, and we need to take advantage of it overall. So based on our analysis yesterday, we expected the crude to rise above the 30-20 level. The 30-20 level did hit. Of course, the first time that that was tested, we had a stop loss if you were entering it, but the second one was success, and we are still holding on to it. Now, if we look at the market, we can see that the pair has bounced off the 150% Fibonacci retracement zone, the commodity, not the pair. And if we go on overall overall price action side, we will see that the next resistance that we have is at the 88% Fibonacci retracement zone, which is at $32.01 level. And it is likely that we will have a break above it. So we can expect the pair to rise up to 32.23 level. And that's the level overall where we have the falling trend line. If that level is broken above and we see the break above of 32.75, then we are likely to see further bullish development, as the first target will be at $34.16, and my final target will remain at 36.24 level, and maybe 36.60 level, where we will have the major resistance level for the crude oil. I'm not really bullish on crude. However, we will be expecting to see some turmoil now that crude producing countries are kind of waking up. Up until now they were sleeping, and up until now they were war, literally price war I'm talking about, between Russia and Saudis. There was a price war between Iran and the Saudis. So we now see that these countries are waking up, and they are starting to realize that the war that they're creating is not bothered by anyone, but it is basically damaging their own countries. So we will see interesting developments. That being said, my bullish overview still stays intact. I believe that on hourly time frame, if we see a break above today's this hour's candle, the highest high, we are likely to see the further continuation. So we are looking for a break above 31.45 level, and the first and immediate target will be at 32.01. If that level is broken above, we'll look for $33. And finally, for the day, we should be expecting to see a cap at 34.25 level, which is approximately $3 development from where we are today. So this is about crude oil. Now back to US dollar Turkish lira. We had on Monday an entry on this pair, which was at 295.30 level. From there onwards, we saw a hike, almost 300 pips actually, from this pair. And yesterday, the tide turned against, and our entries were basically closed out. So if you are still holding to that entry, you can I believe go on and hold on to it. For one main reason, the fact that we had terror attack yesterday in Turkey, and it has got 29 people killed in the capital of Turkey. So we are likely to see that the Turkish government is gonna step up in their Syrian operations, and they claim that we need to defend our country from the terrorists and so on. We at A to Z Forex 7 Markets condemn the death of the innocent people. However, it is likely also that we will see this death of innocent people to be turned into political game in the coming days. So we will be seeing definitely the US dollar Turkish lira rising, overall Turkish lira depreciating against all of its counterparts. So watch out. If you want to enter the position again, you can consider entering at 296.70 level. Consider your spread. Currently, I'm looking at 8 pips spread on this pair. So go ahead and take advantage of it. But be cautious, because it's a politically driven currency pair, and there is now the correlation of politics, correlation of economic crisis, and the banks are in fear. Plus, the government is fighting into gaining respect in the region. Let's put it that way. Now, let's move on to New Zealand dollar. As we discussed yesterday, unfortunately, my previous analysis, I had drawn my Fibonacci a little off. So as we said yesterday, the reversal happened 30 pips before where we initially expected. Sometimes it happens. So if you were to catch the bullish attempt yesterday, you would have at least now have approximately 30 pips to 60 pips profit. Nonetheless, we are still looking into that triangle formation, and there is also another resistance level over here that we are looking at. Let me make it bold. So based on this resistance trend line, we need that level to be broken above to consider bullish attempts. There is also another one over here, and we need that one to be broken below in order to consider bearish attempts. So you will see one significant level over here, and it is the connection level of these two lines. If you look at it closely, it marks as a, let me just put it like this. I'm referring to this line. If you look at that level closely, it marks as a significant resistance support level. Going backwards, you can see that that level is turning into resistance support. So it is a very significant level. So we need to look for daily candle closing above or below this level in order to define which direction the pair is going to be taking. My suggestion and my belief is that we are going to be looking for bullish developments, and it is because of the following two candles confirmation. If you combine yesterday's candle into the day before's candle, so basically Monday, so basically the Wednesday and Tuesday's candles that I'm referring to, if you combine them, you are getting to have a reversal candlestick formation. So that means that for the next 2 days, which is today and tomorrow, we are actually looking for a bullish market development from New Zealand dollar, US dollar. So the target we will be having for this pair would be at 0.6775 level for the time being, and that's a very significant resistance level that we can see. In the meantime, if you have any questions, please feel free to ask. Now, let's move on and take a look at the gold on daily time frame. We can see that, as we said yesterday, the pair or the commodity found its support at 1197 level. So 1197, as we expected, became as a support. And if you combine the two candles again yesterday and the day before, we are looking for a kind of a reversal candlestick formation. So there is a likelihood that we would be seeing the market reversing on gold on bullish side. Our target, if you are wondering, still remains at 1222 level. So we are looking for 1,220 pips or 1,200 points development from gold. And if we look onto it closely, we can see that the market is basically forming a bullish development overall, despite the fact that there has been a kind of a reversal. So my expectation at this given moment will be that the market is going to be still going down a little bit further towards 1200 level. So I'm really looking for this one candle over here, the 11 o'clock server time candle of the 16th of February. So possibly from there onwards, we will see upward development. So if you're going to be taking advantage of this market development, do make sure that you are using at least $8 stop loss. So consider your risk appetite, and your target again is going to be from there onwards to 1222 level, and if that level is broken above, we will be looking for 1230, and finally, last but not least, 1244 level. That will be our targets. Our final currency pair for today is going to be euro dollar. We can see that euro has found itself as support at 110% Fibonacci retracement zone, and that is also the 1.11 level. So we are still looking at the pair to define its trend, because if we look at it clearly, between 1.11 and 1.1240 level, we are looking for a sideways development. It's not a trend yet. So basically, this level to this level, we are looking for the market to be on sideways. And that being said, there is a likelihood that it's going to be on bearish side for today because of the developments from the ECB, Mario Draghi, etc. So I would be looking for the market to basically find itself and to correct itself. But that being said, although there is a likelihood that the pair is going to go bearish, I am going to be looking for long in the euro dollar for real, and that's going to be from 1.0985 level, and I will be longing it to 1.1370, 1.1360 level as my initial targets will last. And possibly from that level, unless something very, very bad happens, we might even see the pair to rise to 1.1860 level. This is it so far for today. Now I'm at your disposal for your questions. The question is, could you advise what should one look for in trading USD Turkish lira in terms of taking long opportunities? The first thing that you need to understand is the financial instability in Turkey, because the country is at the edge of a major crisis. It has happened already almost 2 years ago. It has started 2 years ago. And now we are looking for a deepening crisis there. So whenever you see any negative announcement from banking system in Turkey, that's a sign that the Turkish lira will start depreciating. Secondly, whenever you see any crisis between Russia and Turkey, which is ongoing, that's a sign of bullishness for USD Turkish lira or sign of bearishness for Turkish lira. So you look for crisis, fundamentally, you look for technical levels as well. And the main level that you need to look for is the current 2.9670 level, which is the 50-day moving average. If that level is broken above and the market has closed above that level, then you are going to be looking for decent bullish developments. That's the main reason why I told you a bit ago that you need to look for a break above 2.9670 level at this given moment to keep your bullish targets, and your first target is going to be at 3.0. Does a break mean break and close above? It really depends on the structure that you are taking, Rustum. For me, I'm looking for a level, let's say, just at this given moment, I'm looking for a break above that level. The second, we see that 296.70 level is becoming 296.71. For me, that's considered to be a breakout. Of course, I always have 30% chance that I'll be caught up with a fake breakout, just like yesterday's crude oil, because we were actually caught up yesterday by first fake breakout and then the correct one. So whenever it happens, I will just re-enter the position one more time. It's okay, as long as you are not over trading. Do you look at the COT report at all? And Nazim is commenting that when you are trading New Zealand, you need to look for diary features. I agree with you, Nazim. New Zealand is a diary country. It's the diary capital of the world. You need to understand what drives each country's economy. Like the Canadian dollar is driven by the oil prices, while Australian dollar is driven by the news from China mostly. On the other side, the New Zealand dollar is mostly driven by the agriculture, but among agricultural products, they are driven by the dairy products prices. So when we had last year a virus in the sheep New Zealand, we saw the New Zealand dollar depreciate. So that's why that's also another proof for you that this currency is a commodity currency. Agriculture products are also commodities, and anything happening to their dairy products, the dairy prices, etc., will have a direct impact on the price of New Zealand dollar. $30 a barrel, is this a fair price for crude? Well, crude is not something that can be valued as fair price or not fair price. Of course, you need to look at it as from the production value as well. There are some countries whose production cost is $8 to $16 per barrel, and there are some countries whose production cost is well above $60, $70 per barrel. So, of course, for those countries whose production is above $30, whenever the price goes below 30, it damages them, and they are not able to, sustain it. There are also some countries whose economy is very much depend on the crude prices, and due not to managing their budget properly, they end up pricing or expecting crude prices at the wrong level, and they also get in trouble. One good example is Azerbaijan, where I am from originally. So when you see that the government is not really calculating their budget properly, they end up in a budget deficit. If that is becoming the case, then the local currency of that country becomes hit. The only way to overcome this issue is just to look at it from a brighter perspective. If that currency is controlled by the central bank, the only choice they have is to ease their currency, and that way they can guarantee for themselves that they will not be basically melting down their foreign currency reserves. So to come back to your question, $30, the only person that can say that crude oil prices is fair at $30 is the market, because crude is a commodity driven by supply and demand. And right now the demand is low for it. In order for countries to sell their supply, they need to offer it low. And a very good example is Nigeria as well. Yesterday, I also shared a very interesting outlook that Nigeria is having problem right now to find a buyer for their March contracts. March is only 2 weeks from here, and they still haven't found buyers for 25% of their production in March. And it's a very rare scenario for crude producing countries to face up such development. What was the correct Fibonacci wave that you should have drawn? Because I already accepted that I made a mistake last week when I was drawing my Fibonacci before. So you should have connected the 0.6840 level to the level over here at 0.6385 level, basically with the high on daily candle, with the highest high of January the 4th to the lowest low of January the 15th. And if you put it on the weekly time frame, you would see that this is basically the highest high of 2 weeks candle, and then you get to have the correct Fibonacci wave, and you would see that it has bounced of 61.8%, and it is bouncing off the 38.2%. and it is basically moving between the two trend lines that we have drawn. So it needs to be broken above or below in order for us to confirm the market development. Thank you very much, everyone, for your time. Today's webinar, as we said before, is sponsored by Trade 360. You can also go ahead on trade360.com and request a $50 no deposit bonus just to test their platform. And I'll be looking forward to see you in our next webinar tomorrow.